Hey there, lifestyle property people, it's Shiv Haria here, and today we're going to talk about inflation, interest rates, and how all that affects property. So the first thing you'll have noticed is that at the moment, everything from property to petrol is going up in price, and that is all due to supply chain issues caused by the pandemic. So because of the pandemic, the raw materials needed to make goods have been stagnated, have been stuck in various different countries and not been able to get to the places that they need to get to in order for the goods to be produced. What that ultimately means is that there is less goods being produced and the demand for those goods is arguably higher now that people are comfortable spending again. That demand with that supply means that there is an increase in prices of stuff, and that increase in price, if it's sustained over a period of time, is known as inflation. So inflation is the sustained increase in price in the prices of goods and services. The central bank actually has a target for inflation, and it is a 2% target. So they want to maintain inflation at 2%. And some of you will have read in the news that currently in the UK, inflation is running at 4+%. And in the US, it's actually somewhere in the region of 6+%. So there's definitely some work needed by the Bank of England to bring that inflation back in line with their target of 2%. They've got a couple of levers that they use in order to adjust inflation, and one of those is by manipulating interest rates. So what are interest rates? The interest rate is basically the cost of borrowing. It's the amount of money that a borrower pays in addition to the principal amount, and that is the cost of borrowing that money. However, there are two interest rates that you should know about. One is the base rate, which is set by the Bank of England, and the other is the borrower rate. The borrower rate is the rate that you get charged when you go to borrow money from NatWest Bank. They're two different numbers. The base rate is currently at 0.1%, but when you go to borrow money from NatWest, unfortunately, they don't give it to you at 0.1%. They actually add a percentage on top, or they add an amount on top to cover for profit and their fees and costs and things like that as well. So that number that they add on top is derived by understanding what the actual cost of borrowing in the market is, which is dependent on how well the economy is doing currently, and then also by your personal circumstances. So basically, how risky as an individual are you to lend to? Low interest rates means that borrowing is going to be cheap. And if borrowing is cheap, then more people will borrow so that they can spend and invest, whether it's in their personal lives or in their businesses. All that spending, because there is only a certain amount of supply, leads to an increase in prices. In property, low interest rates mean that the mortgage interest rates that you're charged are lower, or the mortgage interest that you're charged is lower. And if that mortgage interest is lower, then the cash flow or the annual profit is higher. If the annual profit is higher, then of course you're making better returns. And if you're making better returns, more and more people will want those better returns, and so the demand for properties will increase. As the demand for property increases, because the supply is relatively fixed, the prices of properties will also increase. So if the Bank of England increases interest rates, typically what will happen is that returns will decrease. And that is basically because if interest rates increase, the mortgage interest that you pay goes up. If the mortgage interest that you pay goes up, then the annual profit that you make goes down, and so there's less return. And if there's less return, then there'll be less demand for that investment. So, for example, if you are the Bank of England and you increase the interest rates from 0.1% to 0.5%, which is a 0.4% increase, that's only a 0.4% increase on the base rate. However, if you have a £1,000 mortgage at the moment, that £1,000 mortgage could quite easily go up from £1,000 to £1,400 per annum. So that's a 40% increase in your mortgage interest costs. And because your mortgage is typically the largest bill that you have to pay, it's quite a substantial increase. There is one thing to note, though, that all these changes do take some time to work their way through the economy. Most people, because mortgages, the largest cost, fix their mortgages for whether it's 2 years, 3 years or 5 years. And so the people who are on fixed mortgages will have to wait until they refinance for these increased interest rates to impact them. So until they refinance, they will be able to stay on their interest rate they are on currently that they've agreed with the lender, in this case, NatWest Bank. The market has been very, very hot recently, and it's something that we expected a cooling at some point. The cooling is actually not a bad thing, because cooling in the market means there's less people looking for properties, so there's less demand for the properties that we are looking for ourselves and for our clients, and it ultimately means that we can pick up better deals. So of course it's a good time to buy property. As well as that, even with the interest rates increasing, they're not going to increase very quickly, and savings interest rates are still below 1% and will be at least for the next couple of years. As a result, when you look at where to put your money and you're putting it in the bank, you're getting almost negligible interest, and if you put it into a property, at least you're getting some return, although it might be slightly lower than a year ago, for example. Remember as well that the best time to invest in property was 20 years ago, and the next best time to invest in property is today, and property returns are for the long term. I hope that was useful for you, and look forward to seeing you soon. Take care. Bye-bye.